This is Paris Hoover, your Patton University online course instructor for this semester. Unit 7, Introduction. Behavioral theory supports the idea of loss aversion, which asserts that investors suffer greater mental anguish from financial losses in comparison to pleasure from financial gains. Based on this tendency toward loss aversion, some investors are attracted to investment options that provide both the potential for gains and the protection from losses. Option funds suit these investors who are primarily concerned with avoiding losses. Investors prone to mental accounting, separating investments between principal and income, may like investment choices such as warrants, convertibles, and split capital investment trusts. Warrants represent long-term options to purchase previously unissued shares of stock from the issuing company. Warrants allow the issuer to raise additional capital. However, they dilute the earnings per share and residual equity for existing shareholders. Convertible bonds provide investors with the option to convert their bonds to stock based on established rates at a designated time. Split capital investment trusts are composed of income shares and capital shares. On the predetermined date, the fund matures or liquidates, with the holders of the income shares receiving the dividend income generated by the fund in addition to the initial capital investment. The holders of capital shares in turn receive most of the capital growth from the fund. In order to determine whether an option is a good investment, portfolio managers estimate the fair price of the option. Managers and analysts utilize various models to establish the fair value of options. The Black-Scholes model is the commonly used method of estimating fair price. An advantage to this model is the formula-based nature and the quickness of computations. Once the model has established in the software program, managers can easily input figures for the given variables and instantly obtain the resulting estimated fair value. Variations of the Black-Scholes model exist to account for elements such as dividend-paying stocks, currencies, and futures. Binomial models represent the alternative to variations of the Black-Scholes model. Advantages of binomial models include the ability to account for early exercise, interest rate changes, and market volatility. The most significant disadvantage is that the models are not formula-based and require time and work to solve. The complexity limits the use and appeal of binomial models to investment managers. Explore the concepts presented above and more as you make your way through the textbook and video resources of Unit 7. Learning objectives. 1. Illustrate the function and financial behavior of structured notes, warrants, and convertible securities. 2. Distinguish the variations of the Black-Scholes model and the binomial option pricing model. 3. Discuss the characteristics of currency forwards and currency swaps. Please continue to Objective 1. Chapter 35, Warrants, Convertibles, and Split Caps, page 669 to 679. Warrants. Warrants are long-term options. They have expiry dates that lie as much as 5 years or more in the future. Most warrants are issued by the company upon whose shares they are based. If they are exercised, the company will issue new shares. So unlike options, warrants are usually used as a means of raising corporate finance. The issues company receives the money from the sale of the warrants and subsequently receives the money paid upon exercise. In contrast to options, warrants entail the expansion of the number of shares in issue. This can be to the disadvantage of the existing shareholders, and that the future profits are divided among a larger number of shares. This is known as a dilution. In consequence, dividends per share may be reduced. Warrants are often attached to newly issued corporate bonds when the warrants are issued. The presence of the warrants renders the bonds more attractive to investors, and hence the issuing company can raise money or more advantageous terms in that it needs to pay a lower rate of interest than would otherwise be the case. In most instances, the warrant is detachable from the host bond and can be traded in its own right. Some warrants are issued naked, that is, without the presence of corporate bonds. Since warrants pay no dividend or coupon, they provide an issuing company with the source of finance that involves no serving cost. Serving costs do not arise until the warrants are exercised. Covered warrants. Covered warrants, sometimes called third-party warrants, might be written without any involvement of the company on whose stock the warrants are based. They do not entail the issue of new shares upon exercise. Covered warrants may be either calls or puts, whereas other warrants tend to be calls. Many covered warrants are written on stock indices or foreign currencies. The capital fulcrum point. The capital fulcrum point is the minimum annual percentage increase in the share price that makes it worthwhile to hold a warrant on a share rather than the share itself. It is the rate at which percentage returns on the warrant overtake the percentage returns on the share. Share price rises greater than the capital fulcrum point render the warrants preferable to shares. The rate of share price rise up to the warrant expiry date is the relevant rate. The existence of capital fulcrum point arises from two factors. 1, the existence of time value, and 2, the effect of gearing. The increase in intrinsic value caused by the share price rise must exceed the loss in time value resulting from the passage of time. So the share price must rise at a particular rate simply for the holder of the warrant to break even. There would be a further rise in share price required for the gain of the warrant to catch up with the gain on the share. This catching up is possible because of the gearing offered by the warrant. The formula for the capital fulcrum point is shown below. Where CFP is the capital fulcrum point, K is the strike price of the warrant, S is the share price, W is the price of the warrant, and T is the number of years to the expiry date of the warrant. For example, suppose that the strike price is 100 and the current share price is 145. The price of the warrant is 80 and the expiry is 5 years. Application of the formula provides a capital fulcrum point of 9% PA, and if the share price rises at a faster rate, the warrant is the better investment. If the share price increases at a slower rate, the share provides a higher percentage rate of return. Convertibles. A convertible might be looked upon as a corporate bond with an attached warrant. Convertibles are often referred to as convertible bonds and involve the right to convert the bonds into shares at specified rates and points in time. The investor pays nothing to convert apart from surrendering the convertible bond. The period prior to the first possible date for conversion is known as the rest period. The usual arrangement is for conversion into the shares of the company, which issues the convertible bond. Occasionally, the conversion is into the shares of a different company, in which case the instrument is called an exchangeable bond. Some convertibles provide the right to convert to other bonds rather than shares. Convertible preference shares are preference shares with the right to convert to ordinary shares. The number of shares for which the convertible bond can be exchanged is referred to as the conversion rate. For example, the convertible may allow the conversion of 100 pounds par value of the loan stock into 20 shares. Multiplication of the conversion rate by the share price provides a conversion value. A share price of £6 would imply a conversion value of 120 pounds. In some cases, the conversion rate declines over the life of a convertible bond. A convertible bond would also exhibit an investment or straight bond value. This is the value of the bond in the absence of the right to convert. The investment value is the price of corresponding straight bond. The market value of a convertible would normally be higher than the greater of the conversion and investment values. The excess of the market value over the greater of the conversion or investment value is often referred to as the premium. Figure 35.1 illustrates the relationship between conversion, investment, and market values of a convertible. It is assumed that the conversion rate is 20 and that the investment value is 90 pounds per 100 par value. The market value of the convertible is shown as the broken line. The investment value, and hence the strike price of the implicit option, is not immutable. A rise in interest rates would lower the investment value and strike price. Similar effects would arise from a decline in the credit standing of the company. Such a decline in credit standing requires a higher rate of return, which, a given constant coupon, implies a fall in the price of a straight bond. Convertibles are hybrids in that they constitute a compromise between bonds and shares. They provide more upside exposure to share price movements than bonds, but less than ordinary shares. They provide less downside protection than bonds, but more than shares. The percentage rate of the dividend or coupon yield would be less than that of a straight bond, but probably more than that of the ordinary share. Please continue reading to page 679. Chapter 38, the binomial option pricing model. Page 711. The first major advance in option pricing was made by Black and Scholes. Arguably, the next was made by Cox, and takes the form of the binomial model. Black-Scholes model are, strictly speaking, applicable only to options that cannot be exercised before expiry. Binomial models can deal with the possibility of early exercise and hence can be used for the valuation of American-style options. Another advantage of binomial models relative to Black-Scholes models is that they are capable of allowing for variations in the interest rates and volatility over time. A major disadvantage of the binomial model is that it does not permit an analytical solution and must be solved numerically. This means that there is no formula that can be programmed into a computer or calculator. Instead, a computer must be programmed to ascertain the solution by an iterative process. This can take a considerable amount of computer time. Binomial models use portfolios that replicate the behavior of options, such portfolios being referred to as equivalent portfolios. This is based on there being a portfolio of shares and debt that will behave in the same way as the option. Correspondingly, the fair price of the option equals the value of the portfolio. Although the exposition of the binomial model in this chapter will treat the time to expiry of an option as being one period or divided into two periods, practical application of the binomial model requires the time to expiry to be divided into a much larger number of periods, whereas some users consider as few as 15 periods to be sufficient. Others regard 30 as the minimum number of periods. One-period binomial model. The basic principles of option pricing can be indicated by means of a simple binomial model. Although this simple form of the model is highly unrealistic, it nevertheless conveys the essence of the principles underlying more complex option pricing models. Suppose that a share, which is currently priced at 100p, can have one of two values 1 year hence. These two values are 150p and 50p. Further, suppose that a call option has a strike price of 100p and an expiry date 1 year hence. Figure 38.1 shows binomial trees for the share and option. At the end of the year, the share will be worth either 150p or 50p. The call option with a strike price of 100p will be worth either 50p or 0. Binomial option pricing looks for the share-based portfolio that has the same prospective payoffs as the option. The share-based portfolio is referred to as the equivalent portfolio. Suppose that it is possible to buy fractions of a share and that money can be borrowed at 0 interest. The purchase of half a share for 50p, which is financed partly by borrowing 25p, will replicate the call option. The portfolio of 0.5 of a share plus the debt of 25p is equivalent to the call option in terms of prospective outcomes. If the share price rises to 150p, the value of the portfolio will be 50p. This arises from a shareholding worth 75p and a debt of 25p. The value of equivalent portfolio is therefore equal to the value of the option. If the share price falls to 50p, the value of the portfolio will be 0. This is because the shareholding is worth 25p and the debt is also 25p. Again, the value of the portfolio is equal to the value of the call option. Since the call option and the equivalent portfolio have identical payoffs, they should have the same price. The construction of the portfolio involves net cash outflow of 25p. It follows that the cash outflow for acquiring the option should also be 25p. In other words, the price of the option should be 25p. Multi-period models. Figure 38.2 illustrates two period binomial trees. The value at the end of the period is referred to as the node. Starting with just one node, the number of nodes increases with the passage of each period. The distance between the highest and lowest nodes also increases over time. The initial share price is S. In each period, the share price may rise by U or fall by D. At each node in the binomial tree, for an option, there is an option price. There will be two option prices in the next period arising from each node, one for the up state and one for the down state. At the end of the final period, the option would have no time value. Its price would equal its intrinsic value, which is the higher of 0 or the share price minus the option strike price. At each node in a binomial tree for an option, it is possible to construct a portfolio that will behave in the same way as the option and exhibit the same end of period values. The portfolios for calls consist of shareholdings together with debt. The call option price should equal the value of the portfolio. The quantities of shares and debt are ascertained by solving simultaneous equations. The number of shares corresponds to the option delta. The equivalent portfolio will be different at each node. The change in the portfolio from one node to the next will be self-financing. This self-financing condition means that cash flows arising from the change in the quantity of stock are precisely matched by the change in the size of the debt. So as time passes, there is no cash inflow to or outflow from the equivalent portfolio, and the proceeds from one period's portfolio will finance the next period's portfolio. Please continue reading. Chapter 36, Option Pricing in the Black-Scholes Model, page 680 to 689. Option prices as the cost of replication. One way of looking at option prices is to see the option price as the expected cost of replicating the option. Option positions can be replicated by positions in the stock. The positions in the stock should provide the same profit-loss outcome as the option being replicated. The amount of stock should reflect the option delta. The delta is the change in the option price resulting from a 1p change in the stock price. For example, an option on 1 million pounds of the stock with a delta of 0.7 would tend to give the same profit or loss as 700,000 pounds of the stock. Such replication will involve cash flows. Replicating long option positions involves buying shares when the price of a stock rises and selling when it falls. This is because a rise in the price of a stock causes the increase in delta and hence the need to buy more of the stock. Conversely, a fall in price lowers delta and necessitates selling. Buying high and selling low entails a net cash outflow. The theoretical value of the option equals the expected losses from such transactions. So replicating long option positions as results in losses that correspond to the value of replicated option. Conversely, the replication of a short option position would be expected to provide profits that correspond to the value of the option. The cost replicating an option is the basis for the Black-Scholes option pricing. The determinants of the option prices. Probably the most popular way of calculating the fair price of an option is by means of the Black-Scholes model. An intuitive feel for this model can be obtained by regarding it as equating price with the expected payoff from an option. Expected payoff is used in the sense of possible payoff outcomes, weighted by their probabilities of occurrence. Figure 36.1 illustrates this with respect to the options of the FTSE 100 stock index. The curve in the upper part of figure 36.1 is a normal distribution curve and indicates the probabilities of the various possible outcomes. The profile ABC in the lower part shows the payoff possibilities from buying a call option. Suppose that the area under the normal distribution curve between 1600 and 1610 as a proportion of the total area under the curve is 0.19. This means that there is a 19% chance that the index will fall between 1600 and 1610. If the area under the curve between 1610 and 1620 is 0.15 of the total area, there is a 15% probability of the index being between 1610 and 1620. The statistical expectation of the payoff from the call option is given by the sum of the possible payoffs when each possible payoff is weighted by its probability of occurrence. The calculation of this expected payoff is illustrated by table 36.1, in which, for the sake of simplification, the possible payoffs are represented by the midpoints of the respective ranges. Table 36.1 involves some simplifications that would be avoided in the actual calculation of expected payoff. In particular, the midpoint of a range is not the best measure of the average possible outcome within the range. Nevertheless, the table serves to illustrate the principles behind the calculation of a fair price of the option using the Black-Scholes model. In the example shown, the fair price of the option expressed in index points is 8.2 at 10 pounds per index point. This corresponds to a money price of 82 pounds per contract. The option price estimated by means of the model is referred to as the fair price. The fair price may differ from the option price observed in the market. Intrinsic value is the payoff from the immediate exercise of an option. In the case of an in-the-money call option, intrinsic value is the stock price minus the strike price. Time value is the excess of the option price over the intrinsic value. The time value is at its greatest when the option is at the money and declines as the option moves to being either in the money or out of the money. This behavior of time value can be explained intuitively. An out-of-the-money option has to reach the at-the-money position before movements of the index can start generating opportunities for exercise. Thus, an option buyer would regard an out-of-the-money option as less valuable than an at-the-money option, since some leeway has to be made up before it reaches the threshold of payoffs from exercise, whereas at-the-money option is already at this threshold. Consequently, the option buyer is prepared to pay less for an out-of-the-money option. Conversely, the option writer would accept the lower price because of the reduced chance of loss. This line of responding also underlines the role of the market forces demand and supply establishment of option prices. Black-Scholes calculations merely serve as guidelines to buyers and writers. Please continue reading to page 689. Objective 3, currency forwards, futures, swaps, and options. Read pages 732 to 737. Pricing currency forwards and futures. To a large extent, the determination of forward prices and of future prices is similar in that they both reflect interest rate parity. Forward prices and future prices should be very close. The mechanics of price determination may differ between the two markets in that currency forward prices are likely to be based on the cost of hedging the provision of forward contracts, whereas future prices are likely to be based on arbitrage. Interest rate parity. The current price of a currency is referred to as the spot price. If the forward price of a currency exceeds the spot price, that currency is said to be at a premium. For example, if the spot price of the sterling in terms of US dollars is £1 to every $1.50, the 6-month forward price is £1 to every $1.55. Then sterling is said to be at a premium against the dollar. Conversely, if the forward price is less than the spot price, the currency is said to be at a discount. With a spot exchange rate of £1 to every $1.50, a forward price of £1 to every $1.45 means that sterling is at a discount against the US dollar. Interest rate parity describes a relationship between spot and forward currency prices. One way of looking at this relationship in terms of equality between the forward premium or discount on the one hand is the difference between the two interest rates on the other. The premium or discount offsets the difference in interest rates. For example, if sterling yields the higher interest rate, it would trade at a discount to the US dollar. This means that the forward price of sterling would be below the spot price so that from the perspective of the dollar-based traders, there would be a guaranteed capital loss from holding sterling that matched the additional interest from sterling deposits. Conversely, if sterling interest rates were below the US dollar rates, sterling would trade at a premium in the forward and futures markets. That is, the forward price of sterling would be greater than the spot price, so that there is a capital gain that compensates for the lower interest returns. The interest rate parity relationship can be described by the following equation, where our dollar is the dollar interest rate for the period to the maturity of the forward futures contract. Our pound is the sterling interest rate for the same period. F is the forward or the futures price sterling, and S is the spot price of sterling. Coverage interest arbitrage. Arbitrage plays a crucial role in the determination of the prices of futures contracts on foreign exchange. The arbitrage is usually referred to as covered interest arbitrage. The arbitrage can be seen as being between the futures contract on one hand and synthetic forward contract on the other. The arbitrage involves buying the cheaper of the two simultaneously, selling the more expensive. The fair futures price is the futures price that provides no opportunity for the arbitrage profits. The price of the futures should equal that of the synthetic forward. To illustrate the general principle for the case of currencies, consider futures contracts on sterling using the US dollar as the base currency. The synthetic long forward involves borrowing dollars and simultaneously buying spot sterling, which is put on deposit. There is no initial cash outlay, but on the maturity date, a sum of sterling is held and a dollar debt is to be repaid. So the transactions that occur on the maturity date are equivalent to those under a forward contract. Dollars are paid and sterling is received. If sterling futures are overpriced relative to the synthetic, an arbitrage profit can be made via synthetic long forward position together with the short futures position. If a price of buying forward sterling by means of synthetic is lower than the futures price of sterling, the dollar receipts from selling sterling via the overpriced futures will exceed the dollar debt to be repaid. The difference constitutes the arbitrage profit. This arbitrage is illustrated by figure 39.1. Conversely, a futures price below the synthetic price offers an arbitrage profit from buying the futures and simultaneously taking a short position in the synthetic. The short synthetic position is established by means of borrowing sterling and using the proceeds to buy US dollars, which are then deposited. On the maturity date, the sterling debt is repaid and the dollar deposit matures to provide US dollars. If the futures price is below the price provided by the synthetic, it would be possible for the arbitrager to construct the synthetic forward and use the dollar proceeds to buy sterling through the futures contract. The amount of sterling thereby obtained would exceed the sum needed to repay the sterling debt. The excess would be the arbitrage profit. This arbitrage is illustrated by figure 39.2. Please continue reading to page 737.